Welcome back to the street here on BNN Bloomberg. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back with Robert Wessel. He's with Hamilton ETFs to continue digesting the bank's results of this morning and the themes that we've seen through the course of the past 2 days when all of the big five banks have released results. And Robert, one thing you wanted to talk about, and I think it's on the mind of investors as well, is rising provisions for credit losses. You understand them very, very well. What does it mean to the banks and to the ultimately to the share price performance? Yeah,
so just to step back for a moment, I think when you think about how this has all evolved over the last couple of quarters, you had the market pricing in, a pretty deep recession, and valuations went down significantly. The banks have been trading, oscillating between 9 and 9.3 times forward, which is very, very low. And that's the market saying loan losses they think will be higher than the street. And in the last couple of quarters, the analysts have held firm and said, we're comfortable with our assumptions. And then you came into this quarter, they brought their numbers down a little bit as they kind of felt a little bit of the pressure from macro, and then everybody's missed. But at the end of the day, the big picture is that credit is normalizing. One of the reasons the banks are missing is they're building reserves. So they've built about $1.5 billion over the last couple quarters. So that's a lot. These are just against performing loans. So this is them building in for future bad news. Remember, the market's forward-looking, so is bank reserving. And so I think there's two ways of thinking about it. Is credit deteriorating or is credit normalizing? And it's really doing both.
What does normalizing mean in this context?
Well, the long-term average for Canadian banks is they would lose about 40 basis points of provision ratio, as you mentioned earlier. They've been well below that in the previous quarter, so you're seeing that trend higher, back to 40. It's not like it's 120 like it's been in previous credit cycles. So some perspective is in order for here.
And they can take provisions for credit losses are a judgment made by a bank, and they can make those, as you've indicated, take provisions on performing loans. Those are loans that are up to date, but the bank has reason to believe that they may fall behind, correct?
Right.
Or impaired loans, and those are loans that are already behind, correct?
Absolutely correct. And so they've been building the reserve against performing loans. This is very new accounting, so everybody's trying to figure it out. It's created almost all the volatility in earnings over the last 3 years, and that number has been built up about $1.5 billion. So the market's forward-looking in discounting for future deterioration, but so is bank reserving. And so when you look at where you are today, ROEs are still 14%. This is still, results are still holding in.
There is apprehension, of course, about a recession in Canada and the U.S.
I think
credit
both.
is likely to get worse, correct?
Yeah, but I think the central question right now for Canadian bank investors is the analysts are saying, we think the banks will report about $12 billion of loan losses this year. And the market, by virtue of the fact that you can infer by its discounted valuation, is saying we think it's going to be a lot higher than that. But if you look at the first 2 quarters of this year, so far the analysts are much closer than the market is, quote unquote.
Your company, Hamilton ETFs, is a provider of ETFs in the market, and that company has put a new one on the market within the past month or so, correct?
Yes. So we launched the Hamilton Canadian Bank Equal Weight Index ETF, ticker HEB, and that's for investors who are, sort of neutral on the markets, or they're long-term investors. There's no leverage in that one. We have a leveraged ETF, one with modest leverage, HCAL. But yeah, so this is for people who want to get a simple and easy way to invest in the Canadian banks, and it's the lowest fee of all Canadian bank ETFs.
It sounds like it sounds very similar, if not identical, to a Bank of Montreal ETF known with the ticker symbol ZEB. We often look at it here on the screen, correct?
Absolutely. So it's based on the exact same index, but it's a lower fee.
What is your view of the banks right now in terms of valuation?
I mean, they're very inexpensive. So as we've said before, history has been very kind to long-term investors who buy the Canadian banks at 9-ish times earnings, as long as you can wait. You don't get those valuations when there's storm clouds. You don't get them when there's rainbows and sunshine. You get these valuations when there's storm clouds. The question is the storm going to be severe enough to offset the foundations of the companies in terms of capital and profitability? And I think the analysts are on top of things.
Would you buy banks at these levels?
Well, the banks haven't gone up for 2 years. So the question is, what are the odds that you're going to go 3 years without any market appreciation of the Canadian bank sector? And I think if you go back, and I don't have the numbers off the top of my head, I would say that's a pretty good risk reward. I mean, right now, if you're bearish the Canadian banks over the next 12 months, you're betting that they're going to have negative returns over a 3-year period. And, that doesn't happen very often.